Do you know how to invest in stocks? If you consistently invest your money, you might be able to make it grow by a lot over time. Because of this, it is very important to start investing as soon as you can and as soon as you have saved some money for this purpose. Also, if you want to start investing, the stock market is a good place to start. You can get started even if you only have $1,000 saved up or can only afford an extra $25 a week. Keep in mind that there is a lot you can and should learn about investing in stocks if you want to reach your financial goals. Let's guide you in how to invest in stocks if you're a beginner. Let's give you instructions on how to start. Number 1. How much risk are you willing to take? How comfortable are you with taking risks, like the chance that you might lose money when you invest? There are many different ways to group stocks. Some of these ways are by market capitalization, aggressive growth, value, and small market capitalization. All of them are dangerous, but in different ways. Once you know how much risk you are willing to take, you will be able to focus your investment efforts on picking stocks that fall within that range. Number 2, find out what you want to achieve with your investments. You should also decide what you want to get out of the investment. When you open an online brokerage account with Charles Schwab or Fidelity, they will ask you what your investment goals are, as well as the level of risk that was previously mentioned that you are willing to take. If you are just getting started in your career, one of your investment goals might be to build up the amount of money in your account. If you're an older person, you probably want to make money as well as grow and protect your wealth. Your goals for investment could be to buy a house, save money for retirement, or pay for your children's or grandchildren's education. A person's goals can change over time. Just make sure that you write them down and look at them often so that you can keep your mind on achieving them. Number 3, figure out what kind of investor you are. Some investors want to be involved in the day-to-day management of their investments, while others would just rather set it and forget it. Your choice may change over time, but you need to decide on a strategy before you can move forward. If you are confident in your investing knowledge and skills, you might be able to handle both your investments and your portfolio on your own. Traditional online brokers, like the 2 listed above, let you invest in a wide range of financial instruments such as stocks, bonds, mutual funds, index funds, and exchange-traded funds. If you work with an experienced broker or financial advisor, they can help you make decisions about your investments, keep track of your portfolio, and make changes to it. This is a good option for people who have never invested before but know that it's important and that they need someone with experience to help them. Most of the time, it costs more to use a broker or financial advisor than to use a robo-advisor, which is an automated hands-off alternative. A robo-advisor will take care of your investments automatically after getting information about your goals, how comfortable you are with risk, and other factors. 4. Choose the right account for your money. Workplace retirement plan. If your employer offers a workplace retirement plan like a 401k, you can invest in a variety of stock and bond mutual funds as well as target date funds. It's possible that it will also give you the chance to buy stock in your employer. Once you enroll in a plan, contributions are automatically made at a level you set. There's a chance that your employer will put in the same amount to the matching fund. Your contributions are tax deductible and the growth of any balance in your account is put off until a later year. This is a great way to increase the return on your investment while putting in as little work as possible. It could also teach investors to invest regularly. You can also start buying stocks by opening an individual retirement account or IRA or a taxable account at a brokerage. You can also buy stocks through a mutual fund if that's what you'd rather, even in addition to having a workplace plan. You can also choose a regular brokerage account that charges fees. When you invest in stocks, you usually have a lot of choices. These types of investments include individual stocks, stock mutual funds, and exchange-traded funds, and stock options. A robo-advisor account is a type of account that takes your investment goals and uses them to make a stock portfolio for you. Number 5. Learn how to make your investments less risky by spreading them out. Diversification is an important concept to understand if you want to manage your money well. Investing in a variety of assets, also called diversification, makes it less likely that the performance of a single investment will have a big effect on the return on your overall portfolio of investments. It's a way of saying that you shouldn't put all of your money in one place. In other words, you should put your money in different things. If you don't have a lot of money, buying individual stocks can make it hard to spread out your investments. If you only have $1,000, for example, you might only be able to invest in one or two businesses. This means that the risk is higher. This is where mutual funds and exchange-traded funds can help. Mutual funds and hedge funds both usually have a lot of stocks and other investments. Because of this, buying them is a better way to spread out your investments than buying a single stock. What accounts can you use for investing in stocks and other securities? People who want to buy stocks can choose from many different types of accounts. Even though you can only get some investment accounts and retirement accounts through your employer, you can open some or all of these types of accounts through the options listed above. Accounts for retirement. Individual retirement accounts, or IRAs, and 401k plans are the two most common types of retirement accounts. The first one can only be opened by an employer, but it can be opened by any individual retirement account, IRA, through a robo-advisor or online broker. These accounts often have tax benefits that encourage you to save for retirement and act as an incentive to do so. However, they also have limits on how much you can put into them each year. Other types of retirement accounts include a SEP IRA, a 401b, and a solo 401k. Accounts for investing that are taxed. The retirement accounts we talked about above usually give you some kind of tax break for your investments and have limits on how much you can put in. Profits from investments in stocks made through taxable investment accounts are taxed the same way as other types of income and don't get any special treatment. Also, there's no limit on how much can be contributed. If you're putting money away for qualified education costs, you can use an education savings plan or an education savings account to invest in stocks. Most people who invest in stocks do so through mutual funds or target date portfolios. If you look at it, it depends on how involved you want to be with your stock investments. You can set up your investment accounts with a broker, online or through your financial advisor, your bank, for Coverdell ESAs, or your employer. If you want to manage your own stock investments, you can set up the accounts with a broker, online or through your financial advisor, for employer-sponsored plans. How to put money in your account. If you want to use a retirement account, such as an IRA, to invest in the stock market, you might want to set up a monthly automatic deposit. As an example, the most you can put into an IRA in 2020 is $6,000 if you're under 50 and $7,000 if you're over 50. If your goal is to put in as much as possible over the course of the year, you could set up a monthly deposit of $500. In this case, your goal would be to put in as much as you can. If you want to buy shares of a stock through an employer-sponsored retirement plan like a 401k, you will have to choose a percentage of your pay or set a dollar amount that will be taken out of your paycheck. First, set clear goals for all of your other types of investment accounts. Then, decide how much of your monthly spending budget you want to put into stock investments. To make sure that your stock investment goals are met on time, you can either transfer money into your account by hand or set up automatic deposits. Here are a few things to keep in mind when making your investment spending plan and adding money to your account. Mutual funds have rules about how to buy them. Many stock mutual funds have minimum requirements for the first purchase. If you want to start investing in stocks as soon as possible, you should look into different options. Morningstar is a great place to do this, to find the ones that have zero or low minimums. Trading costs in the form of commissions. If you have a brokerage account that charges a commission to trade, you may want to increase your balance so that you can buy shares, especially individual stocks, when the commission is only a small part of the total amount you have invested. Fees for mutual funds. Before you buy shares in a stock mutual fund, you should look into the load that will be put on the shares. Some mutual funds may charge you a front-end or back-end sales charge, or load, when you buy or sell shares. Even though not all mutual funds have loads, Knowing that you might have to pay one can help you avoid any extra costs. Start investing in stocks. Start your investment plan by picking the individual stocks, exchange-traded funds, or mutual funds that fit your needs the best. If you choose a robo-advisor, the software will put the amount you choose into a diversified portfolio of investments that has been made with your goals in mind. If you hire a financial advisor, they will buy stocks or mutual funds on your behalf after talking to you first. After the order has been successfully filled, the securities will be put into your account, and you can start getting the benefits of investing in the stock market. You should also know that your funds will either make money or lose money depending on how the economy is doing. But in the long run, you will be part of an investment field that has been helping people get richer for more than 100 years. Think about signing up for a dividend reinvestment plan at the same time you buy your first stock, also called a DRIP. Reinvestment plans are ways to invest that let investors use dividends from stocks, mutual funds, or exchange-traded funds to buy more shares of the same fund or stock they already own. You might end up with fractional shares, but that means that more of your money will be put to use and less of it will be sitting in cash. Thank you for watching this video. Please make sure to subscribe to this channel.